You know that feeling when you're on the highway at night? Everything's fine, music's on, cruise control is set. You feel totally in control.
Yeah, smooth sailing.
Exactly. And then, out of nowhere, you feel this little vibration, and suddenly, all the dashboard lights just flash on at once. Engine dies. And you realize you are not driving the car anymore.
That is a very, very specific kind of panic. And a terrifying one.
It is. And that's pretty much what happened to the United States financial markets this week. We are not talking about some small correction. We're talking about the whole engine seizing up mid-flight.
It was a brutal moment of clarity. For the better part of a year, the story coming out of the U.S. has been soft landing, roaring 20s 2.0.
Oh, clear skies.
All clear skies. And then in just a few hours, the market looked under the hood and, well, it realized the whole engine was gone.
It felt like a multi-asset meltdown. It wasn't just one thing. It was stocks, crypto, private loans, even silver. Things that aren't supposed to move together all just fell off a cliff.
And that's the key. The correlation went to 1. When everything sells off at once, it's not a rotation. It's a verdict. It's the entire system screaming that something is fundamentally wrong with the American economic story.
So that's our mission today in this deep dive. We're going to be detectives. We're going to investigate this market crime scene. We need to find the signal in all this noise.
And find the smoking gun.
Exactly. But before we do, a really important caveat for everyone listening. Everything we were talking about today is specific to the United States. This is U.S. data, U.S. markets.
Right. This isn't necessarily what's happening in your local economy, but, the U.S. consumer is the engine of the entire global economy. So if that engine stalls over there, those shockwaves travel fast.
The diagnosis for the U.S. patient matters to everyone.
It does.
Okay. So let's open the case file. The first thing that really caught my eye, the first victim, if you will, wasn't the usual suspect. It was in a corner of the market that's supposed to be boring. Private credit.
Yes. The BDCs, business development companies.
All right, can you just quickly break down what those are for people?
Sure. Think of them as shadow banks. After the 2008 crisis, the big U.S. banks got really cautious. They stopped making risky loans to medium-sized American companies.
So these BDCs stepped in to fill the gap.
They did. They're lending to all those companies that are, too big for a small local bank, but not big enough to issue public bonds. They're a lifeline.
And a huge player in that space, a company called Blue Owl, their stock didn't just dip, it cratered. And the weird thing is, management came right out and said, everything is fine.
They did. They held a conference call. They basically said, our loan portfolio is perfect, no problems here, no cockroaches.
So you have the CEO on one side saying everything's great, and the market on the other side saying, we don't believe a word you're saying. Why that disconnect?
This is a perfect example of what traders call the cockroach theory.
The cockroach theory.
Yeah, it's an old Wall Street saying. The idea is if you walk into a kitchen that looks totally clean and you see one single cockroach scurry across the floor.
You don't assume it's just one cockroach.
Never. You assume there's a whole nest of them hiding in the walls that you can't see yet. The market saw one potential problem and assumed the entire foundation of U.S. corporate credit is infested.
So Wall Street is betting that hundreds of these mid-sized American companies are secretly unable to pay their debts.
That's the bet. They're saying, we don't trust the official numbers anymore. We think your borrowers are going broke and you just haven't admitted it.
Wow. That's not a profit warning. That's a crisis of trust.
It is.
And it seems like once that trust evaporated in the quote-unquote boring market, the panic just jumped instantly to the wildest corner of the room.
To crypto, yeah. It's the same psychology, just moving at light speed. If private credit is the foundation, crypto is like the weather vane on the roof. It spins first.
It got ripped right off. Bitcoin dropped, like 25% in just a couple of days? But I want to zoom in on Michael Saylor's company, Strategy.
The ultimate proxy for faith-based investing.
Exactly. For the longest time, Wall Street used his stock as a way to bet on Bitcoin. And they paid a huge premium for it, a premium that has now basically vanished.
To really get how big a deal this is, you have to understand a concept called MNAV, market value to net asset value.
Sounds technical.
It sounds it, but it's really just about human psychology. Okay, imagine I have a box, and inside that box is a bar of gold worth exactly $100.
Okay.
But I don't sell you the box for $100. I tell you, this box is special, this box is visionary, it represents the future. And because you believe my story, my narrative, You pay me $140 for it.
So I'm paying a $40 premium just for the story, for the vibes.
Precisely. That was the Saylor premium on strategy stock. Investors in the U.S. were paying a 30% markup, sometimes more, just to bet on his genius, on his narrative. Now that premium is collapsing, it's heading towards 1-to-1. The market is basically saying, we don't care about your story anymore, just show us the gold.
That feels like a massive psychological shift.
It's the death of the narrative. In a bull market, stories are everything. Michael Saylor loves to say volatility is a gift. But when a real economic scare happens, stories become worthless. You can't pay your debts with a cool vision for the future. You need cash.
So it's ruthless. Saylor's out there with these, like, almost religious-sounding affirmations about holding strong, and the market is just completely ignoring him.
It is. And when the leaders of an asset class seem totally detached from what the price is actually doing, it scares the smart money away even faster.
Okay, so the money ran from credit. It ran from crypto.
Yeah.
Logically, it should have run to safety, right, to gold and silver. But that wasn't so simple either.
No, it wasn't. And this is where the detective work gets really fun. Silver, for instance, took a massive hit. Just plunged.
It looked like a tech stock.
It did, because it had become a speculative bubble. There was this whole narrative about a supply squeeze for solar panels. A lot of hot money piled in. It got way ahead of itself.
Another story that just fell apart.
Exactly. But gold is the interesting one. Gold held up much, much better. And it's critical we understand why. Most people think gold only goes up when there's high inflation.
Right, to protect against rising prices.
But that's not what's driving it right now in the US. The main driver is fear. Fear of the opposite, fear of deflation, of an economic contraction.
How can we be so sure it's fear of a recession and not something else?
Because we can check with the doctor.
Dr. Copper.
Dr. Copper. They call it that because it has a PhD in economics. It's used in everything. Construction, wiring, cars, power grids. If the U.S. economy is growing and building things, demand for copper is high.
And if it's grinding to a halt?
Copper demand collapses. So now you look at the ratio of the price of copper to the price of gold. This might be the single most important chart in the world right now.
What's it telling us?
It's screaming. You have copper, the proxy for U.S. industrial growth, absolutely plummeting. At the same time, you have gold, the proxy for fear, holding strong. That ratio is at record lows.
So less building, more fear?
A lot less building and a whole lot more fear. It's telling us the physical, real-world U.S. economy is stalling out while financial anxiety is going through the roof. This is a classic U.S. recession signal.
Which completely flies in the face of the mainstream narrative we've been hearing for months.
The data doesn't lie. You can spin jobs reports, you can manage earnings, but you can't fake demand for raw materials. If U.S. industries aren't buying copper, they aren't building. End of story.
Okay, so let's put the pieces on the board. Trust in corporate debt, gone. Faith in speculative stories, evaporated. Industrial metals, signaling a shutdown. The only thing left standing is fear. Why did this all happen at once? What was the trigger?
It wasn't random. There was a smoking gun. And it was the U.S. labor market data that came out that very same morning.
The JOLTS report and the Challenger job cuts data. These are usually pretty dry. Why did they spark such a firestorm this time?
Well, to feel the shock, you have to understand the expectation. The whole soft landing idea for the U.S. economy, the entire thesis, was built on one single pillar. The American worker keeps their job.
As long as people have jobs, they spend money, and the economy stays afloat.
Exactly. The market was priced for that, for a strong, stable job market. Then, the Challenger report on job cuts came out. The number of planned layoffs announced in January was the highest for any January since 2009.
2009, that's a chilling number. That's the depths of the great financial crisis.
It is. So right away, the alarm bells are ringing. But the real kill shot came from the government's official data, specifically the revisions to past data.
The revisions, where they tell you the good news first and then whisper the bad news a month later.
That's exactly what happened, but on a huge scale. The new numbers for job openings were bad, sure, but then they went back and revised the data for the previous months downwards, massively. All those strong job numbers we thought the U.S. had, turns out they were mostly a mirage.
And the trading algorithms that are programmed based on that data would see that and...
The models just break. The computers that were positioned for a strong U.S. economy suddenly saw data that screamed, recession! They all hit the sell button at the same instant.
That's why it felt so synchronized.
It's because it was. The entire market, all at once, realized it was priced for a 2026 economic boom that wasn't happening. In fact, the U.S. economy might be accelerating into a downturn right now.
It's like that cartoon character who runs off a cliff. He's fine as long as he doesn't look down.
And that labor data forced everyone to look down.
And there was no ground underneath them.
Just gravity. And this connects everything back to the start. If U.S. job cuts are at 2009 levels, who's going to default on their loans?
Yes.
The American consumer. And if they default, the companies they buy from default. And if those companies default,
The BDCs, like Blue Owl, are left holding the bag.
it's all connected. The labor market was the first domino.
So, to pull this all together for everyone listening, we started with this blackout, this multi-asset crash. We followed the trail from a loss of trust in U.S. corporate loans to a collapse of faith in speculative narratives and a screaming recession warning from the metals market.
And it all led back to one culprit, a U.S. labor market that is breaking much faster than anyone was prepared for.
It's like realizing the car you're driving at 100 miles an hour actually has no brakes. The market just looked down and saw the brake line was cut.
That's a great way to put it. And the strange thing is the uncertainty is kind of gone now. We now have certainty. But it's the certainty that things in the U.S. economy are about to get a lot tougher.
And the message from the markets is clear.
Batten down the hatches.
So here's the thought I want to leave everyone with. For months, the U.S. financial markets have been an early warning system, and now they're all flashing red, screaming that the soft landing story is a myth. If the market has stopped believing that everything is fine, how long until the real-world economy over there has to face that same reality?
A sobering thought. Stay safe out there.